Tips ETF for 2021. This is an Investopedia by Nathan Reif. Let's see who old Nathan is here. What is he trying to sell us? There he is. Joined the Boston Conservatory in 2017 and is instructor voice, resident conductor at the Harvard Glee Club. Previously worked for Ryan Consultants and Partners in Performance. Has written for internet brands. Okay. Conductor, education, vocalist. He holds a master of music. Okay. But now, before you guys start saying, why should I listen to this guy? Because experts don't know any better than Nathan or you or I. No one knows. But let's see what he has to say. So he's obviously a good guy with when it comes to Rafe's work as conductor has brought him before ensembles represent some of the broad diversity of the choral world. I thought choral was flowers. All right, so prior to his graduate study, he performed as a male member and music director of the Whiffenpoofs, the nation's oldest all-male capella. Isn't that like, what's his name from the Office, Andy? So he has a BA from Yale and a Master of Music from University of Michigan. Okay, so let's see what he says. So I don't care if you go to Yale. I don't care if that does not impress me at all. But let's see what he says. Exchange-traded funds, ETFs that invest in U.S. Treasury inflation-protected securities, present a convenient way for investors to gain exposure to these government-guaranteed fixed income instruments. Look, and I got to tell you, man, I just did a video, a couple hours ago about the risk of stagflation. I am concerned about that, absolutely. And the stagflation I'm concerned about is because I did not realize that Sniffy Joe was going to be as anti-fossil fuels as he's turning out to be. Already getting rid of the pipeline, the Keystone Pipeline. Who knows what the hell else is going to come? It's that's bad. That's ugly. And if stagflation comes, you're going to need some inflation-protected securities for sure. People think stocks are a hedge against inflation. It's not necessarily. I mean, if you look at 1966 to 1982, stocks literally did nothing. Even with dividends reinvested, yes, you made some money, but after inflation, you got smoked. And after inflation, you got taxes, you got smoked twice. 1870s to 1900, there's deflation. Stocks did fine. Great, as a matter of fact. 1930s, there's deflation. Stocks did poorly. 2000, the aughts, stocks, there's low inflation, stocks did poorly. So there's no correlation between one or the other. It just isn't. But I do know what gets smoked in inflation is fixed income. That's a fact. So that's where tips could really play a role here. Now, look, at the end of the day, I'm not, let's see, what's the 10-year treasury doing right now? It's probably up. Well, no, wait. 10-year treasuries, is the yields are down, so that means the prices are up. That's interesting. So the yields are down, but I mean, the yield was at was it 10? Yeah, so let's go, hold on a second. So the yields are at, back in July, 0.54, 0.51, man. So 50 basis points. So the yields have doubled in price in the last 6 months. And yet that means the yields have doubled in price. That means the prices have dropped. And that is because of a worry about inflation, without question. So people are selling them because they're worried about inflation. Take a look at the 30-year, just while I'm thinking about it. Now, I don't know if that's I have no idea that's going to continue, but I know I've talked about deflation. I do think there's going to be deflation in some parts and inflation in other parts. Inflation in energy is the one that concerns me most. I got sneezed. All right, so the 30-year treasury is at 1 point. Your yield on the 30-year is 1.84, which is up from 1.22. So that's up 60 basis points. So that's up 50%. Since July, whereas the 10-year is up 100%. Remember, inflation isn't, and I know Milton Friedman, trust me, I get it, but it's not too much money chasing too few goods. Inflation is always dictated by scarcity because of government. I'm just telling you right now, man. Now, I mean, look, at the end of the day, it doesn't have to be government that makes things scarce. I get that. But government is what we're contending with here. Government can make things scarce by making a $15 minimum wage. It makes jobs scarce. They can make things scarce by getting rid of fossil fuels. It means energy is scarce. All that stuff is inflationary. All that stuff is bad for the economy. All that stuff is going to lead to stagflation. All right. It's not like we haven't learned this before. Crazy. All right. So if we do have inflation, what do we want to look at here? Tips, Treasury inflation protected securities. Let's see. U.S. Okay, so TIPS are Treasury securities indexed to inflation, meaning that when inflation rises, so too does the principal amount of the security and the associated interest payments. TIPS spread is an important related metric that shows the difference in yield between TIPS and regular U.S. Treasury securities with the same maturity. This shows how much people are willing to pay for inflation protection and also indicates how much inflation investors anticipate. TIPS ETFs enable investors to safeguard the value of their portfolios by mitigating against the erosion of purchasing power caused by inflation. There are 13 distinct TIPS ETFs that trade in the U.S., excluding inverse and leverage ETFs. They wouldn't want that. As well as funds with less than 50 million in AUM. We don't want that. That's too small. TIPS, as measured by the Bloomberg Barclays Index, have underperformed the broader market with a total return of 9.6%. I just compare that to the Russell 1000. Okay, that doesn't make sense. But be it as it may, the fact that TIPS have performed 9.6% is nuts. The best TIPS ETF based on performance of the past year is a PIMCO 15-year one. But yeah, I don't care about the best performance of the last year. Anyway, so let's take a look here. So performance over the last year is 20.9%. Nuts, man. You're getting each of these funds hold TIPS of various maturities, either directly or through other investments. All numbers are below. Okay, so we just look at the best for 1 year. All right. PIMCO. All right, so okay, well that's fine. I like the expenses low. Not leveraged, that's good. Some of the PIMCO bond funds from Bill Gross there were leveraged, which gave them a nice little boost to yields or a boost to performance. What's this? LT, oh, that's the PIMCO one. LTPZ. LTPZ tracks the Bank of America Merrill Lynch 15-year U.S. inflation-linked Treasury index, which is comprised of TIPS with at least $1 billion in outstanding face value. Okay. The ETFs focus on longer dated TIPS means that higher yields compared to shorter dated securities, but also as increased interest rate risk. That means as the interest rates go up, you have more price volatility. Here we got IVOL, which is Quadratic Interest Rate Volatility Inflation Hedge ETF. Look, if it takes that long to spit it out, don't buy it. I'm sorry. You shouldn't have to. I got the Josh Scalen and Pablo Finney freaking Poop Patrol hat fund. You shouldn't have to say all that. So anyway, here you go. 0.99 is the expense ratio. No, you don't buy 0.99 expense ratio for any bond fund. So we're going to scratch that. Here you go. Good old-fashioned Spider. You don't got Vanguard on here? All right, let's look at Spiders. So Spiders, they made 10%, 12 basis points to the yield. As an expense ratio, the annual yield right now is 2.17, 2.1 billion in assets. Tracks a U.S. government inflation-linked bond index from Barclays, which includes TIPS with at least 1 year remaining to maturity. So basically smaller, lower maturity, shorter maturity bonds in there for sure. Okay, well that doesn't bother me. Let's see what Vanguard is for the Schwab. We got a link TIPS. Let's take a look. The Schwab U.S. TIPS ETF symbol is SCHP. The fund's goal is to track as closely as possible before fees and expenses the total return of the Bloomberg's, the same one we just looked at, the Bloomberg's Barclays U.S. Treasury Inflation-Linked Bond Index Series L. Woo! A straightforward, low-cost fund offering potential tax efficiency can serve as a part of the core of a diversified portfolio. Invest in the overall maturity spectrum of the TIPS market. Good. So there's going to be a wide range there, not just long-term or short-term. 5 basis points. Can't beat that. So let's look at the fact sheet here. Look, you can do this or Vanguard. I have my stuff at Schwab, so I just buy this guy. I'm starting to go more to Schwab. Let's see. 12 billion in assets, had 10-year experience now, inception date 2010. Only got 42 securities, that's fine. Turnover rate 22%, which probably tells me some of those are maturing. They got to turn around, take the proceeds and reinvest in other things. So it's probably have a shorter end of the duration, I think, in the maturity. Do we see average? Let's see. Average maturity on here right now is 5.32% as of 9/30/2020. Distribution yield is 1%, so don't get caught up in this SEC yield thing. Average yield to maturity, 48 basis points right on, so that's not much. Because the TIPS don't pay much as a yield to maturity. You're looking at instead the price increases and whatnot. So over 10 years, yeah, look at that. It's smoked the category over 10 years. So good stuff. All right. So here, well, whatever the category, hasn't smoked the index, but pretty close. So you've averaged 3 point, basically 3.5 over 10 years. I got no qualm with that, because that last 10 years were tough for tips because we hadn't had any inflation. But you just wait. If we do come back to get it, 4 stars across the board. There you go, man. Looks like high credit quality. Interest rate, I'm not sure what that is. That the long term? I can't tell. High credit quality with extensive interest rate sensibility. So is that more of the long term durations? Probably. Anyway, so there you go. So here, average weight maturity 8.5 years, right? Okay, average weight duration 8 years. So that's where they say that a 8-year duration is a high or extensive interest rate sensitivity. I would think 8 and 4 doesn't seem, duration of 8 doesn't seem all that long, extensive. That seems moderate for sure. But all right, be that as it may. They got 15% or 20 years or more, 23%. Yeah, so the bulk of it is less than 10 years, man. Look at that. I mean, the vast majority of, I don't get why they're saying that that's heavy, extensive interest rate sensibility when the vast majority of these bonds are 10 years or shorter. 50% are less than 5 years, roughly. A little bit less than 50%, a little bit less than half are 5-year maturities. That's anyway. This might not be a bad thing, and I don't know what the minimum investment is. 1,000. I guess you buy by share, so I guess it doesn't matter. So there you go, friends. What you should look at buying if stagflation or inflation comes. Tips look pretty good to me. I will see you.